Hello, sir. Welcome to In-N-Out. Can I take your order?
Absolutely. Appreciate you. I'll have an FHA Dutchman, a rate stack animal style, an Escrow waivers, mustard fried, and a DSCR protein style.
That would be our pleasure. Would you like onions on that?
Yeah, is there a sale right now on the whole grilled onions?
That's a great question. I see that you've been educated on what to ask for when you show up at In-N-Out.
It's because I watch In-N-Out Mortgage Mondays.
There it is. And on today's show, you are going to learn what you should be asking your loan officer to learn about the secret menu in lending. Can't wait to share this with you all. Let's get into it. And welcome, Christian, to Mortgage Mondays. Thanks for joining me today. We've got a killer episode on deck here. So In-N-Out Burger has a secret menu. Christian and I are a couple of California kids. We are very used to In-N-Out. And when you live in this world and you learn the ins and outs of In-N-Out, you realize that there are secret things that you can order on the menu. Well, guess what? Mortgages work the same way. Especially if you have a good loan officer, there are things that can be done that will save you money or restructure your mortgage. That will put a little bit more money in your pocket or give you some advantage in a different form. We're going to be sharing those with you today. So Christian, how are you today?
Doing pretty good. Welcome yourself, David Green on Mortgage Mondays.
The first thing on the mortgage secret menu that someone should talk to their loan officer about is the rate schedule. How do you actually refer to that, Christian, on your end when we're talking about a par rate and you can go up or down from there?
Yeah, I call it a rate stack, rate sheet. People call it different things, but yeah.
Yeah, so explain what that is.
Everybody's favorite question to lenders, right? What's your rate, right? That's pretty much how you compare different lenders. And it's funny, with us, we say, well, it depends because it is kind of on a spectrum. I mean, right now, if you guys asked us what our rates are, I would say anywhere between 5 and 9%. And nobody would like that, right? That's not a concrete answer, but in order to quote effectively, we need a little bit more info because your rate sheet is broken down on a whole spectrum. It goes all the way from those low 5% rates that come with a lot of points. Points, for those not aware, are fees that you pay up front, right? All the way up to the highest part of the rate sheet, those 8s and 9% that come sometimes with a credit, right? So that's the opposite of a fee. That's something that the lender will actually pay to you. It's savings. And depending on where your balance and flexibility is between money out of pocket right now versus savings overall in the long course of the loan, which is savings on the interest rate, right? And you can kind of go up and down, slide on the scale.
Yeah, so first off, you can easily be getting taken advantage of because if you say, what's your rate, the lender may know, oh, you're already looking for other rates. So if I give you a higher rate, you as the shopper is going to say, oh, I'm going to go with the lower one. So they're incentivized to lie, or maybe not lie, but just be deceptive. They're going to give you the rate at the very, very, very bottom of the stack, which coincides with higher closing costs, right? So no, when you go in there, if you say, well, how much is your cheeseburger? Well, that depends. Does the cheeseburger come with the Coke, with the fries? Because maybe they say it's only $3, but it's $3 if it's part of a value menu, that portion of the cheeseburger is $3. But if you buy it on its own, it's $4. We don't shop for burgers like that, but if you did, you could be taken advantage of. And then if I'm hearing you right, the next part would be ask yourself, how much does that rate matter to you? Is it worth spending more money up front to get a lower rate for a longer period of time? Or are you not going to own the house for as long? Or you're planning on a refi to where it doesn't matter? And we use a metric we just call the break-even point when we're your loan officer and we're helping. Can you explain what the break-even point is and how people should ask about that?
Oh my gosh, by far the most important question to ask when discussing rates with your loan officer. And break-even point, break-even analysis, same thing. The idea is, depending on how long you're going to hold the house, it may not be worth it to get a lower rate. And everybody's obviously likes, rates have kind of become like a bragging point, right? Like, I have a 2.99, I got a 3.5. People like to kind of shout them out. But there are many people who, especially with BRRRRs, fix and flips, maybe where they're only going to own the property for a year or two, short-term holdings, it's actually beneficial to take a higher rate and get some lender credit so that you basically wipe out all of your closing costs because you're not going to hold that rate long enough to realize the savings anyways, right? I mean, if you're saving 5, 6, 10 grand on your closing costs by taking a higher rate and your monthly payment's only $100 more, that's a win, right? Now, obviously, if you're holding, if it's your dream home and you're going to raise a family in it, that's where we should start considering what's your break-even analysis of a 7, 10, 15-year hold, right? That would be to buy down the rate.
So what's an average, what's the range maybe where the break-even point? Is it somewhere between 3 and 7 years usually?
For most products, yeah, when a buy down is in place, it usually lands in that, I'd say 5-year probably average, but 3 to 7 is a totally good range. But if you're aggressively buying down, it could be quick. For instance, if somebody's, really throwing some money on there, you could have like a 2-year break-even period. It's funny, everybody thinks like the interest, the rate stack, as I called it, is proportional. Like every buy down is the same amount of money. It's not. They're sweet spots. So just like, you go to In-N-Out and you get, anybody knows what the Flying Dutchman is. That's a sweet spot in the In-N-Out menu.
That's exactly right. That leads us to the next question that somebody should ask on the secret menu is which rate is on sale? Now, this sounds weird, but when you understand the concept of the rate stack like Christian and I do, if you come to us, one of our loan officers isn't just going to say, what rate do you want? We're going to say, hey, this rate's on sale right now. Can you explain what that means?
Super weird. Nobody really talks about this ever, but let's use an example. Let's say our rate's 7%, right? And let's say it takes, I'm going to use round numbers here, just make it even. Let's say it costs $5,000 to buy down half a point. So you can get from 7 to 6.5. Everybody stay with me. $5,000 gets you from 7% to 6.5 for interest rate. You would think another $5,000 could get you to 6%, right? You would think it's proportional for every buy down. Going from a 6.5 to a 6 may cost $15,000. So it's actually a sweet spot getting the biggest bang for your buck, just spending the $5,000 and getting down half a point. But don't go any further because then it gets very expensive. And it goes the same way when you go up in the rate sheet. Sometimes there's a sweet spot where the lender can give you some credit, cover all your closing costs, take care of all your expenses.
And the rate only goes up a little bit.
And it doesn't go up very much, 100%. So that's where working with a good loan officer, when you ask what's your rate, a bad loan officer will tell you day one what it is. A good loan officer will give you a range and say, my job is to find you the best spot on this spectrum, right? On this rate stack. And I need an application to see that because I need to know what bracket you fall in, right? We've discussed in previous episodes, credit brackets and all those things.
I was fascinated by this when I first got into the mortgage business and I saw how these rate stacks work. And I was asking that exact question. Wait a minute, it's going to cost me $6,000 to jump down a quarter of a point, but I could go another quarter of a point for only $2,000. Like, why? And the answer was, well, it's complicated, but basically the lender selling the loan, there's an appetite of the people buying it where they'll say, we want to buy interest rates at this point. We want 3/4 of a point higher than par or a point lower than par. Whatever the case would be, they feel good about buying the loan at a certain rate. So if there's more of an appetite for it, they don't have to reduce the amount that you're spending. But if there's less of an appetite, they will put it on sale. That's what I call it. I don't know if that's an industry specific term. That makes it easier for them to sell it to somebody else. So this is a thing you should absolutely ask when you say, what are the rates? 9 out of 10 people, man, if you walk into a fast food place and they're going to say, what do you want? Right? Well, what if you say back to them, well, what's on sale? Oh, we actually have a buy one, get one free. Or if you buy this, you can get that. We never think to ask that question. You can do that with your loan officer and you should. And if your loan officer says, I don't know what that means, you need another loan officer.
Very true. Couldn't have said it better myself.
All right. So we've covered how the rate stack works and when people should buy down their rate or whether they should get money back. Oh, you know what we didn't mention about that? Just something to think about. Maybe you get the higher rate and you get a seller credit of $12,000 and you don't get to brag at the real estate meetup about your rate. You avoid it. But what if that $12,000 was reinvested back into upgrading your kitchen and you bought tile counters and replaced them with granite, you repainted the cabinets and you put all new appliances as well as a new floor? You might increase the equity in your property by $75,000 using that $12,000 to replace it rather than just paying it as closing costs instead so you could brag about the rate. Something to think about, especially if you're going to be refinancing that property later after the rehab, after you've made it worth more money. Next thing that people should ask about on the mortgage secret menu is the 2 months with no mortgage concept. Can you explain how structuring the closing date and how your closing costs are paid can actually buy you some time with no mortgage payment?
Yeah, this is fun for you guys. And this is where when you're writing negotiations, if you're tight on funds to close, right? If you're trying to work through, bring in the right amount of money to the closing table. If you schedule your closing to be usually between the 2nd and the 5th of the month, those of you who have bought property know you usually don't have a mortgage payment your next month. So if you were to close, we're recording this in July. Let's say you close July 3rd, right? You wouldn't have a payment August 1st. You'd have a payment September 1st. So you would actually get the entire month of July because you're closing so early in the month, plus the entire month of August because you never pay the second month after your closing, and you wouldn't have to pay until September 1st. That could be 2 months of rent. That could be 2 months of, time to upgrade the property without holding costs. That could be significant. Some flippers are flipping property in 2 months. Imagine flipping a property without paying your mortgage. That'd be kind of cool, right? Whereas if you close at the end of the month, though, you may shorten that time period. If you close on like the 25th or the 26th, you only save 1 month, right? And there's no really objective change.
Now, in a sense, you're not necessarily saving money when you do this, but you're front loading how much you pay in closing costs that cover on the mortgage. Is that correct?
Correct. Yeah, there is a calculation of the prorated interest, right? right? But if you think of that in your closing cost, typically once you get started with a project or once you start renting, that's when your cash flow calculation starts, right? That's when you're like, oh, I have income coming in, but I have expenses going out. 2 months without that mortgage payment is nice, right? There's also no principal, there's no taxes or insurance. So there are some savings there.
You are paying the mortgage, but it's coming out of your closing costs instead of once the thing starts. Now, is there a way that you can get the seller to cover that for you?
There is with seller credits. And obviously that's a big thing that's going on in the industry right now, with buyers kind of still a seller's market in a lot of markets. But we are seeing seller credits are massively important and huge part of getting these offers accepted that we're getting through right now.
Very good point. So if you want a couple months with no mortgage payment, request seller credits for whatever that amount would be, pay it up front, close at the time of month that Christian here is saying, and enjoy 2 months without having to make a mortgage, which can be nice because maybe you're buying furniture, maybe there's a remodel going on where you're still paying rent where you live right now before you move into the house. You could buy yourself a little bit of breathing room there. All right, the last one for today on the mortgage secret menu has to do with escrow waivers. What are escrow waivers and how can these be used to a borrower's advantage?
Yeah, also another really cool thing that not really many people take advantage of outside of seasoned investors. And escrows, for those of you unaware, are when you pay your principal, when you pay your interest to the lender. Typically, there's also two other letters. There's PITI, right? Principal and interest taken care of. That's just your loan repayment. There's also taxes and insurance. Sometimes you have some MI thrown in there. We'll just bundle that with insurance. But that's your property taxes and your homeowner's insurance. Most people choose to pay that included in their mortgage. So you pay the whole thing. The lender takes those 12 months of payments that you collect for your insurance and then goes and pays your insurance bill for you. You do have an opportunity to just pay it yourself. Okay. That means now your mortgage is only your principal and interest. And then you just go talk to your insurance company on how to keep your policy active. And you go to the county and you pay your property taxes. The reason why this could be a savings is because the lender typically will collect more than they need because they collect what are called reserves. The lender doesn't want to go run down to every last dollar in your tax impact account. So what they do is that they usually require a 2 to 4 month buffer, which means whatever your property taxes or insurance are, they'll collect 4 months of it, 2 to 4 months at closing, which like if you're buying $1 million property in California, that's a lot of money, right? That's significant addition to your closing cost. So if you're able to waive that and just take care of your taxes and insurance yourself, that limits a lot of closing costs. Now, obviously budget and make sure you do keep those taxes paid, but it eases the wallet a little bit at closing table.
So what should a borrower say to their loan officer to spark this conversation to hear their options?
Number one, does this loan product allow for escrow waivers or impound waivers, right? We call them both things in the industry. I've never understood why there's two words for the same thing. But you just ask, hey, does this product allow for it? Because not every product does, right? Some FHA and VA loans require you to have impounds. So just ask, right? Start the question.
Boom. 4 items on the mortgage secret menu that most people have no idea about, and most loan officers are not going to bring up themselves because A, it makes their job harder, B, they don't know that they exist, or C, their company or the lender they work for doesn't offer some of those options.